Hi, my name is Lara Dalmeyer, and I am the co-portfolio manager of the Nedgroup Flexible Income Fund. And today I'll be taking you through some slides to just describe the performance of the fund for the last quarter of the year, and also to just take you through some market insights that we are currently seeing. So looking at the performance of the fund delivered 10.3% gross of returns for the year last year, a very strong return against a cash backdrop of 7.8%. You can see that 3.8% of that return was delivered in the last quarter of the year, where markets experienced a very strong risk-on environment. Just breaking that return for the year down, 5.1% of that came from the offshore component of the fund. That includes offshore bonds, offshore money market instruments, and also the weakening of the currency, which contributed well to that bucket. Nominal bonds contributed 2.8% of that return. Nominal bonds had a decent year. They didn't shoot the lights out, but it was a very reasonable return, especially to that shorter end belly part of the curve where we are positioned, and that contributed nicely. The floating rate component of the fund delivered 3% for the year, or contributed 3% for the year. The very high yield environment in which we find ourselves in, we are very toppish in the interest rate cycle, means that floating element is very juicy, and we are able to deliver around 1.8% above money market in that component of the portfolio. And then the rest was made up of returns by linkers, which was a bit disappointing for the year. Linkers underperformed cash, and then small components from property and converts, etc. Now, just to take you through what we are seeing in the market, I'm going to start with a bit what's happening globally, just to give you a global backdrop, and then I will hone in on what we're seeing happening locally in fixed income markets. So the last quarter of the year, as I mentioned, the markets, global financial markets, experienced a nice risk-on rally, and that was largely precipitated by the markets thinking that central banks are finally going to pivot, as in the hikes and the kind of more hawkish tone that we've been hearing from developed market central banks are going to come to an end, and that we are likely going to be seeing cuts happening this year. So markets got very excited after, in October, the unemployment numbers were slightly higher, the inflation numbers coming out were slightly more moderated relative to expectations, and markets started to think that this is a great environment for central banks to start changing their tone. And we did then experience this massive rally from the end of October, down November, down to December. You can just see yields across the yield curve rallying significantly. What's interesting is that not only did this happen with US markets, but markets were also pricing that cuts were going to happen from the ECB as well as the Bank of England, and this was all being priced to happen in the early part of the year. Come the Fed meeting, the FOMC in December, this kind of solidified the market's narrative, where they came out a lot more dovish than what we've previously heard, and cemented this rally strongly into year end. So the chart that I've shown you here is the FOMC dot plot. So it is what the members of the FOMC essentially project as being the rates up at the end of every single year. And if you compare what they were projecting in their September meeting to the December meeting, you can see just how much lower they actually thought rates were going to move in 2024. So they actually signaled that rates would be 75 points lower at the end of 2024 in the December meeting than what they'd previously thought in their September meetings. If you also listen to Powell's tone, he made mention of the fact that they are now considering cuts, which is a very, different narrative than what we've heard previously. And he also cautioned against tightening for too long, and that there could be kind of severe economic long-term effects if they keep doing that. So certainly a lot more hawkish than we've heard, a lot more dovish than what we've heard in any of the other previous meetings. But we have to take a step back. So yes, they are starting to talk more towards this pivot that everyone's gotten very excited about. But inflation, which is naturally the most important component of their mandate, is still a problem. This is the US inflation numbers. This shows you headline inflation And more importantly, what they would focus on is core inflation, because that excludes more volatile elements like energy and food. Core inflation in the US is still sitting at 4%, way above target. So yes, the numbers looked like they were edging more towards a dovish narrative. It is definitely the case that markets got a little bit ahead of themselves in what they were pricing, because it's very difficult for the banks to move aggressively on a cutting cycle if this is still where inflation is sitting. And concerningly, it is still that US services ex-shelter component that is very related to the labor market that is showing excess stickiness. So there is still quite significant inflationary concerns that we are seeing. And we believe that we might be in this environment where it's very, very hard for inflation to move back down to the target for a significant period of time. If you look back and you try to see why has inflation become a problem, yes, there were supply chain problems, around COVID, but a very large driver of inflation, in our opinion, has been because markets have just been flooded with liquidity. And that was largely being done off the Fed's QE program and other central banks' QE programs. So the Fed has started tightening. They have started what we call quantitative tightening, which means that they drain liquidity from the market. And that naturally should counteract a lot of the inflationary impact that we've seen. But the Fed, the Treasury is making the Fed's job exceptionally hard. Why? Because they are injecting liquidity into the economy. So if you look at the net effect, which would be looking at what's happening to the Fed's balance sheet, what's happening to the Treasury's general account, and what's happening in the reverse repo market operations. If you look at overall US liquidity, it is running very, very sideways. And in our opinion, this makes it very, very hard for inflation to remain under control for an extended period of time. So what's now happening on the local front, now that we've kind of seen what's happening in the offshore markets? On the local front, it is very likely that hikes are finished, but it is also very likely that we are not going to be seeing this deep cutting cycle in local markets. Our base rates are probably not high enough. We have a neutral rate which is probably needing to be pushed a bit higher around fiscal concerns. And although we don't have an inflation problem, there are a number of forecasts that suggest that inflation is not going to easily reach the midpoint of the target band. There is a case to be made that, as we kind of see this fiscal deterioration and bigger inefficiencies in the economy, that inefficiencies lead to inflation. The cost of business is very high. So overall, the risks to inflation are on the upside. So given all these kind of reasons, it is hard to see a very deep cutting cycle happening locally. But having said that, naturally a cutting cycle will come, but in all likelihood it will lag what's happening in the developed world, and in all likelihood it won't be this very big cutting cycle, which likely won't provide the relief that I think many are hoping for. What does this mean for bonds? Bonds aesthetically are still cheap. If you look at the real yield above inflation, naturally they are providing a very attractive return. But if you look at the components that are making up that return, the implied risk premium in the 10-year point of the curve is around 3.5% to 4%. Given what your view of long-term inflation is, and that is probably fair. So building the valuation up, it's probably fair, but you do have to realize that we are at the top of the cycle and the real return is still attractive. So there is still an argument to be overweight duration at this point in time. We like nominals in kind of the belly to shorter end of the curve. The fiscal risks and the unknowns in the longer end of the curve are not really something that we want to be investing in at the moment. And we do like the shorter end of the curve on the linker side, where the break-evens are quite low, and we do think that likely inflation will be slightly higher than those break-evens over time. So that is how we currently position there. In terms of the Rand is still weak in our opinion. Unfortunately, it's been weak for a very long period of time. What this chart is showing you is a PPP model, a purchasing power parity model, where we basically devalue the Rand by the inflation differential of us and our trading partners, generally because we run slightly higher inflation. And we will also adjust this model for fundamental characteristics, like what are our deficits looking like, particularly on the current account and the deficit account. What is our growth looking like? And if you look at this chart, you can see, yes, the Rand is trading cheap, quite significantly cheap on a PPP point of view, but that cheapness is moderated slightly because our fundamentals are so poor. But it is our view that a fairer value on the Rand is most likely closer to 17. Given the fact, however, that we might see interest rates staying higher for longer, given the fact that we don't think that central banks can pivot as quickly as what a lot of market participants would hope, we might see this weakness still persist for a while. In terms of what the portfolio looks like at the moment, given that backdrop, as always, we construct diversified portfolios. We don't construct for a one-event outcome. The portfolio has a very strong yield. It's got a very low-risk footprint. So if I take you through every component, we've got just more than a third of the fund in a floating rate component, so that's nice. It's just a yield without the risk, without the duration risk, and there we're earning about 1.8% above money market. In terms of duration, we are slightly higher on duration, but still moderate enough levels, and on the shorter to belly end of the curve, where we will participate in monetary policy benefits, but not so much risk from a fiscal policy point of view. So we're running about 0.8 years local nominal duration. And then from the inflation-linked bonds point of view, although we hold 15% in ILBs, those are very short-dated, so it's only contributing about 0.3 years to linker duration. And then we also have some offshore bonds. That's at about 11%, with about another 10% in offshore money market instruments. Overall, the offshore duration is about 0.3 years. We have managed to construct a nice offshore component without too much duration because of the inversion of the yield curve, and we have played that duration quite carefully. So we do think it is a nice allocation to have in the case of a risk-off environment, as those do provide very nice diversification to the local component of the portfolio. From a dollar point of view, we have about 3.8% effective exposure. We do think the Rand, as I said, is slightly cheap, so that exposure is quite low. But we do dynamically manage that exposure over time as the Rand moves against the dollar. So, yeah, that is our views on the market. That's what the portfolio looks like at this point in time. As we mentioned, we think it's a very attractive proposition. It's got a very low risk footprint, a very attractive yield, and we're excited about the prospects of the portfolio for the next 12 months. Thank you for taking the time to listen to us, and keep well.